Alrighty. So in today's video, I'm going to be sharing with you a few safe and simple option strategies that are going to be suitable as a form of retirement income. So if you are planning for your retirement, or maybe you're already at your retirement age and you want option strategies that are generally safe, then these are strategies that you can use. Now, before I actually get into the option strategies, I want to first talk about the characteristics of the option strategies that we are going to choose, right? So this is going to be important because some of the option strategies out there in the options world could be a little bit risky. So here are a few characteristics that I think are going to be suitable as a form of retirement income. Now, the very first characteristic is that we're going to be getting into option strategies that does not require us to get long shares, right? So basically, we do not want to get assigned. That means that we're not going to get into strategies like the cash secured put or the wheel strategy, right? So the whole idea here is to get into the options and then get out of the options. This way it's much more clean and neat. And also these option strategies, we are generally going to hold them for not too long. So these are going to be short duration trades where the holding time is somewhere from 24 to 45 days, and I'm going to explain a little bit later on why this is so. Now you might be wondering, Davis, what about the shorter time frames, right? Like for example, maybe 7 days, 1 week, or maybe 0 DTE. Now I'm not a very big fan of those strategies where the time frame is very short, and I'm going to explain to you why later on. Now, the next characteristic is that we are only going to choose option strategies where there's only risk to one side. Now, there are two reasons to this. The very first reason is that it's much easier to manage, right? If there's only risk to one side, we only have to worry about that, and then we manage according to that. And the next one is that we're going to have a very strategic way to select the underlying. So in this case, for these strategies that we're going to use as a form of retirement income, we generally only want to choose positive drift stocks and ETFs, right? So this way, if we know that the market is going to keep going up over the long term, and we're going to stick to strategies where there's only risk to the downside, then this way we know it's going to be less riskier and much safer. And again, I'm going to go in depth into this when we get into the strategies. Now, next, we're going to get into also only safe strategies. And what this means is that we are going to get into strategies where the max risk is kept on each trade. So we won't be getting into strategies where it's undefined, whereby, if the market has a very big adverse move, you can lose a lot. So we're not going to get into those strategies. And finally, the last characteristic is that you can even trade it with a very small account. All right. So now, without further ado, let's get into the actual strategies, starting with the very first one. And I'm going to be sharing with you a total of 3 retirement income strategies, right? So the very first one is the short put spread, also known as the put credit spread. So for those of you who are not already familiar of what the short put spread is, it's basically just 2 very simple strategies, right? You have your short put. So this is the short put on the left hand side down here. Let me just get my marker. So you have the short put down here, and then you have the long put down here. Now, the whole idea here of the long put is to cap the max loss, right? So this way, if the market really crashes all the way down to way below the current market price, or maybe even goes to 0, you do not have to be worried or afraid that your account will be wiped out, because your max risk has already been capped by this long put down here, right? So this way, all you got to focus on is where you're going to put your short put spread. So generally, we always want to put it below where the current market price is. So as you can see down here, the current market price right now is somewhere around 179.86, right? So generally, when we put on the short put spread, we want the market to either just go somewhere sideways, or maybe go down but above our put spread, or go up, right? So as you can see with the short put spread, depending on how you actually place it, there are actually many ways that you can profit from it, right? So this is much better than if you were to just trade outright, right? If you were to just trade the outright underlying, let's say for example, you were to just buy it at this point down here, if the market goes up, you make money, but if the market goes down, you lose money. But with the short put spread, and if you were to put the short put spread, very strategically at certain places, which I'm going to share with you later on, then there are, a few ways that you can actually win. If the market goes up, you'll be in profit. If the market goes sideways, you still can be in profit. And if the market goes down and it doesn't get below your short put spread, you can actually still profit. Now let's get into the DTE selection, which means is the days to expiration, right? How many days left does the option have to expiration? So how long do we want it to be? So for me, generally, I like to go for somewhere above 45 DTEs. And the main reason is because we have a positive edge, right? The positive edge is where the RM, which means the realized move, is more often the time lesser than the expected move. Now, I already explained this in detail in another my video called the number one secret to getting consistent profits. If you haven't watched that, just go ahead to my channel and you will see that video. Now, the main thing about this you need to know is that when you go for the DTEs that is above 45, you are going to win more often than the probability of the trade suggests, right? So I'm going to share with you the main reason why we have an edge above 45 DTE, and it's because of this table down here that the Tasty Trade team have already done. So this table down here is very significant in terms of the statistics, because you can see over here, this data collection has been since 1993. So this is quite a long time. So as you can see over here, if you notice, there are two boxes that I have boxed out here. So you have the red box and you have the green box down here. So the edge lies when the realized move is less than the expected move. That means the expected move is greater than the realized move. So a very quick graphical representation of what I mean is that this is the expected move. Expected move is basically depicted by the mathematical model, which is all baked into the options probability. So it is trying to tell you that there's a certain percentage that it will stay within this zone down here, right? Let's say from here to here. But the actual realized move is much smaller. So that means to say the actual move that actually happens in the market is actually lesser than this. So why this is going to be an edge for us is basically it just means that we're going to win more often than we actually should, skewing the win rate in our favor, which overall will make the whole trade profitable for us over the long term. Okay, so as you can see down here, this is the study already done by the Tasty Trade where they did it on SPY just to measure, the expected move versus the realized move. So after, many statistics that have been collected, you can see that anywhere from 7 days to 30 days, you notice that the expected move is actually not bigger than the realized move, right? So you can see the expected move based on, the mathematical calculation of the options. It says that it's going to be of a certain percentage, right? As you can see down here, it's not going to be very much different from the actual realized move, right? This is actually when the market already moved, right? What it has happened in the market. You can see that it's actually not that much of difference. In fact, in all the cases down here from 7 to 30 days, it's actually bigger, which means to say your realized move, instead of it being smaller, right, it's now bigger. What this implies, by the way, this is supposed to be a straight line. Forgive me for not being able to draw this properly. But basically, the implications is that the opposite happens. Instead of winning more often than you should, now you're actually winning less than you should, which means to say you're going to lose a lot more, which is going to skew the whole probability against you, and it's not going to work out in the long term, right? Now, but what if it's 45 days and above? So as you can see down here below, the one where I boxed out in green, you can see for any time above 45 days, you'll notice that the expected move is bigger than the realized move. That means we have the edge, right? In the long term, it's going to work out for us. We're going to be positive expectancy because of this very reason down here. Okay, so this is the main reason why I like to choose the DT that's above 45 and not below that. So if you're going to go below that, now, doesn't mean that you're not going to make money. You still can make money. It's just that the chance of you actually making money from the expected move strategies is going to be a little bit harder, right? In order for you to profit in the shorter term, you probably have to be more directionally right? So if you're not very good at picking directions, then you probably might want to go for above 45 DTEs. Now, next, let's talk about underlying selection. So for this, because we're trading the short put spread is generally a bullish strategy. That means for the most part, we want the market to go up, right? If the market goes down, then we're going to lose money. So for this, a lot of people, this is where I notice actually tend to go wrong, right? They just choose the strategy based on short put and try to find, areas where they think the market is going to go up just through technical analysis. Now, nothing wrong with that. But I think that you can actually add an additional layer to your favor, like can add more, one more criteria to make the probability skewed in your favor. And that is to choose fundamentally good stocks as well as the index ETFs, because they have positive drift. That means the market wants to go up over the long term, right? So for example, one of the fundamentally good stocks that I like, and I think that's fundamentally good, is Google, right? As you can see, Google has just kept going up ever since inception. So, at any time whenever there's a dip, if you were to put on the put spread, then guess what? The chances of you actually profiting is going to be generally higher than if you were going to choose stocks that, you had no idea where it's going to go, right? So that is why, you want to go for fundamentally good stocks or index ETFs. And in this case, as you can see down here, this is the S&P 500 ETF. So the most widely traded one would be the SPY, right? So SPY. So as you can see down here as well, over the long term, the market just wants to go up. So you're doing yourself really a good favor, a big favor, that if you're going to choose these strategies, or rather you're going to choose this underlying that, in the long term is just going to keep going up, you place a put spread, it's going to work out more often than not. Now, if you're just starting out, especially if you're, new to trading options, you consider yourself a beginner, then the safest is to go with index ETFs. And the reason is because they are less volatile. If they're less volatile, there's a lesser chance of your put spread going fully in the money. And also with index ETFs, there's no earnings or individual stock risk, right? For individual stocks, when there's earnings, as there can be very big gaps, right? And if there's going to be a very big gap down, that's where it's going to hurt the strategy of the short put spread. And also sometimes, individual stocks, they may release certain news where it's going to affect the stock price, right? For example, if there's going to be a very bad product launch, then the market is going to read it as a very negative sentiment. They're going to sell the stock a lot and the market is going to gap down. So generally, if you want a much safer trade, then you go for the index ETF. So as you can see down here, this is the data by the TC Trade team again, and they measure the standard deviation move of the stocks versus the ETFs. So as you can see down here, the ETFs, you can see most of the movement is concentrated in a very narrow range, right? Which means to say, even though if the market was to go against you, the chances of it really moving much greatly against you is not that high compared to stocks, where you can see stocks, the standard deviation move can be pretty big. So again, if you want to have much safer trades, especially in your retirement years, you do not want to have that stress, having to wake up in the middle of the night just to worry about your position, then guess what? Just go for the index ETFs. All right, so how do we get into a trade? So if you are just starting out, you consider yourself a beginner, then what I suggest is to use what is called an overbought or oversold indicator, right? So there are two that I know of so far. The first one is stochastic oscillator. The other one is RSI. So as you can see down here, this is of the stochastic oscillator, right? As you can see, there's these two lines over here. If it's above this line, then it's considered overbought. If it's below, it's considered oversold. So for our purposes, because we're trading the short put spread, which is generally a bullish trade, we want to look out for when the oscillator, right, is going below this line down here and it gets into the oversold region, right? So when it gets into the oversold region, then there is going to be, a better probability that the market is going to go up than it goes down, right? Now, that is not to say that the market won't keep going down after it shows an oversold reading. Remember, this is not some kind of a magic indicator that is going to work every single time, right? Like probability is going to work more often than not. And also you need to understand that you need to have proper risk management in place as well. So if you want to be strategic, you generally want to wait until the market is oversold before you consider putting on the short put spread. Why? Because if you think about it, this stochastic oscillator only has three readings. Either it's overbought, somewhere in the middle, or it's oversold. Now, if you think about it, which one do you think is much more strategic to place a short put spread? When the market is overbought or when it's oversold? Now, generally, of course, when it's oversold, right? So as you can see over here, this is of Google. Like I mentioned, this is one of those fundamental stocks. Now, by the way, how do you determine whether a stock is fundamentally good or not? Now, there are many aspects to this, but generally, one of the ways that I like to see is look at the track record, right? The past 5 years, whether the earnings and revenue is growing. If it's growing, then I think there will be considered a fundamentally good stock candidate, but of course you want to do your own due diligence. Okay, so let's get back to the stochastic oscillator down here. So if you want to know the settings that I use, I already have a video that I created all about it. Again, just go to my channel and search for stochastic oscillator, and in that video I'll just share with you all the settings that is displayed down here. So as you can see down here, this is of Google, and every time there is an oversold reading, it somehow coincides with the market going back up again, right? As you can see, this is pretty much the turning point, right? All 4 times whenever the market, or rather the stochastic oscillator, shows an oversold reading, the market has bounced up. So if you place the short put spread in any of these times, well, there's going to be a great likelihood that you're going to be profitable. Now, as you know, it's not all the time this oversold indicator is going to be a turning point for the underlying that you're going to trade. So that is why we want to have an added measure to add the probability further in our favor, and that is to identify the support areas on the chart, right? So as you can see down here, I've already drawn a line over here. So basically, support areas are just places where you see that price has difficulty going down, right? As you can see down here, price tried to go down, it bounced back up, tried to go down a few times, and finally it come back down again after going up to test this same support area again. And this is a place where, you know, we can actually consider putting on a short put spread, because right now, not only do we already have a support area in place, but we also see that the stochastic has shown an oversold reading. So at this point in time, we can actually place a put spread, and this is where you want to construct your short put spread below the support area. So as you can see down here, this is the support, and we basically just want to put it, you know, anywhere below this support line down here. So where you actually want to place your short put spread really depends on how aggressive you are and also how bullish you are. If you're extremely bullish, you might want to put your short put spread somewhere just below the support. And if you do it this way, you're going to get more premiums, right? You're going to get higher premium, but the trade-off is that you're going to get a lower win rate in terms of probability. And it just makes sense, right? Because it's just closer to the market. But if you want to be a little bit more sure, you want to have a higher win rate, you want to play a little bit more safe, then you want to position your put spread slightly further away from where the current market price is. And the trade-off is that you're just going to get lower premium. So at the end of the day, there is no one best place to put the put spread. It really comes down to, you know, your preference, how you feel about the underlying, and also how defensive, how safe you want to play it. All right, so now that we have already talked about the entries, let's talk about how are we going to exit the trade. So to exit the trade, there are going to be a few methods. Now, the very first method is to use a fixed take profit. Right, so for example, maybe you might want to choose a 50% take profit target, which means to say that you want to take profit at 50% of the credit that you receive, right? So let's say, for example, you receive a credit of $2. If you receive a credit of $2 for this trade, then 50% just means it's $1. So if this trade down here drops to $1 in terms of the credit, then this is where you can take profit and you make $1 on this. So that means to say you'll be making $100 on each put spread that you put on. Okay, so this is for method number 1. Now, method number 2 is to exit at 21 DTE. So there are 2 reasons for this. The very first reason is that based on performance-wise, the T-Trade team already has done quite a lot of research on this, and they found out that if you exit at 21 DTE, the performance is going to be far superior than if you were to actually exit at expiration. And the second and more important reason that I think is very important for us is that when you actually get past 21 DTE, that's the time where it's going to be a little bit more risky in terms of being early assigned. And this is specifically for if your trades are in the money, right? So if your short put spread is in the money, and if you're going to hold it past 21 DTE, then this is where you could get early assignment on this short put down here. And if you do get assigned, then you're going to be long 100 shares, and you could get into a margin call if you do not have enough capital in your account. So to make it, very simple, at the latest point, right? Get out at 21 DTE. And method number 3 is the combo of number 1 and 2. Well, basically is that if at 21 DTE, it doesn't already reach the 50% take profit or whatever take profit you set at, then you just exit the trade. All right, so this is the short put spread, and it's very important that you understand this because from here on, the other 2 strategies that I'm going to share with you are also going to involve the short put spread as one of the component, and then we're going to manage it also pretty much the same way. So if you understand this concept about the short put spread, what I've just shared with you already, then you're going to find it very simple to construct the income strategy number 2 and number 3, which I'm going to get into right now. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So retirement income strategy number 2 is the Jade Iron Condor. So I've touched on this a little bit in quite a number of my other videos, but for this, I'm going to share with you a very specific way for you to trade where it's just meant for, a retirement style of trading. So what exactly is the Jade Iron Condor? So as you can see down here, one of the components of the Jade Iron Condor is the short put spread, right? So this is the same short put spread which I shared with you in retirement income strategy number 1, right? You have this short put spread. Now for the Jade Iron Condor, you have one additional strategy that is added on to this short put spread, and that is the short call spread, right? The short call spread, also known as the call credit spread or the bear call spread. Basically, you want to also add this short call spread to further add more credit to the overall trade, right? So for example, if you had maybe $1.50 for this put spread, if you were to receive maybe another 50 cents on this, overall, you're going to have more credit than if you were to just trade the put spread on your own, right? Just the put spread by itself, you're only going to receive $1.50. But with the call spread, you add on to it, you get another 50 cents, you get a total of $2, right, for this credit spread. So your premium is going to be much more. Now, how you're going to construct this call spread is going to be pretty unique because you want to have a certain width to this. And basically, you want it to have a smaller width than this short put spread down here. The reason for this is because you want the total credit, right, to be more than the call spread width in order to have no risk to the upside. So the way we are constructing this Jade Iron Condor down here is whereby even if the market actually shoots past the call spread, there's still no risk to you, right? In fact, it's still going to be a profit. So this is slightly different from the traditional Iron Condor, right? The traditional Iron Condor, if the market goes past the call spread, you are going to lose money, right? But for this, you're not going to lose money. You're going to profit a little bit as well, right? Although not as much as if the market stays within this zone down here. So you might be wondering, Davis, why do you want to, complicate things and add a call spread down here, right? Why don't you just do with this put spread down here? And that is a good question, right? And it's very valid that you can just put on a put spread for sure. But you need to understand is that when you add the call spread, it becomes a not so bullish strategy, because remember, not all the time the market will just keep going up straight. So we may use the strategies that we have used earlier on to try and define, pinpoint where the turning point is. But not all the time the market is going to keep going up, right? There'll be times where the market actually just stays within this zone down here, right? If it stays within this zone, then guess what? You are actually going to profit more if you have this call spread down here. And this call spread down here, we're going to choose a certain delta, which I'm going to share with you later on, whereby there's not going to be that much of a chance that the market is going to go above this point down here. Remember, the delta already depicts what's the probability that the market will go past that point, this strike price at expiration. So if we were going to choose a delta whereby we know that it doesn't go that often, right? In fact, most of the time, if it goes below this call spread, then it does you good that you actually add this call spread and add more credit and premium to the overall trade. All right. So the very key thing that you need to understand while constructing this Jade Iron Condor is that the total credit has to be more than the call spread width. So it basically just means this, right? It's going to be very simple. If your call spread width is going to be $1, you need to make sure that your total credit, right, your total credit you're going to receive is going to be more than $1. Why is that so? Because you need to understand, first of all, that the max risk of your call credit spread is basically the width of the spread. If it's a $1 spread, that just means is that your max risk is going to be $1, right? Or rather, per spread is going to be $100. So if you're going to have a credit, total credit that's going to be more than $1, let's say for example you receive $1.50 to, or maybe even $2, then you know that if the market goes all the way up, you're going to lose $1 on this, but there's still going to be a spillover. The spillover is going to be somewhere from, all right, if we take 50 cents, if we take $1.50 to $2, then it's going to be anywhere from 50 cents to $2. Sorry, to $1. So in this case, if the market goes up, you're still going to make profit. But for the most cases, if the market stays within this zone down here, then you're going to make a lot more. Now, next, what about the DTE selection? So like I mentioned before, once you already understood how we trade the short put spread, everything else becomes the same, right? Pretty much the same. So for this, the DTE selection, again, we're going to choose above 45 DTEs because that's where the positive edge is going to be. And as for the underlying selection, same thing as well. We're going to go for individual stocks and index ETFs. Basically, individual stocks, what I mean is the fundamentally good stocks, fundamentally strong stocks. And if you're a beginner, right, just starting out, then go with the index ETF because again, less volatile and lesser chance of, your put spread going in the money. Okay, so how do we enter into the trade? So here's the beauty of these strategies that I'm going to share with you is that we're going to use a very common entry strategy to make everything similar. Now, so in this case, similar to the short put spread, we're going to use the stochastic oscillator or the RSI, and we're going to look for the oversold reading. Once we have identified the oversold reading, then we want to identify the support areas on the chart. And then now there are two parts to this. So the short put spread, same thing as the short put spread as you learn in retirement income strategy number 1. We want to place it below the support area. All right. Then next, you want to construct your short call spread. So this is where you want to place it anywhere from 25 to 40 deltas. And by that, I mean the short call, right? So the short call is going to be anywhere from 25 to 45 deltas. So for example, if you're a little bit more bearish on the trade, then you are not so certain that the market is going to go all the way up, you still want to put on the trade, then you can go for a higher delta, 40 deltas. If you go for 40 deltas, you're going to get even more credit on the trade. At the same time, construct it where the overall credit is going to be greater than the call spread width. Because this case, if the market just goes up, you are still going to be in profit. Now, if you want a wider max profit zone, then you can go for the 25 delta. So this is where you really want to just play around with the strikes and see what kind of credit you can get. All right, so next we are going to talk about how to exit the trade. So again, it's going to be very similar to the short put spread. So you're going to have a fixed take profit. So maybe it's going to be 50% or 40% or however much you want it to be. And method number 2, exit at 21 DTEs. And again, I've already explained the reason why. And finally, method number 3 is the combo of methods 1 and 2. Now, the only main difference that you need to also think about is if your call spread goes in the money. Now, when your call spread goes in the money, there is not going to have any loss, right? If you construct it properly. If you construct it the right way, whereby the total credit is more than the call spread width, you're going to be in a profit. However, you need to understand right now is that your call option down here, your short call is going to be in the money. And this is where, you could get into an early assignment if you get into a point whereby the extrinsic value is very little. So that is why, again, it's very important that you do not exit the trade past 21 DT, because at that point, that's when the extrinsic value is going to really drop and the chances of you getting assigned on this call option is going to be higher, right? And if you're going to get assigned on your call option, you're going to be short 100 shares, right? So same thing if you don't have the capital or the funds in your account, you're going to get a margin call. All right, so this is retirement income strategy number 2. And let's now get into the final income strategy, number 3, and that is the put broken wing butterfly. So what is the put broken wing butterfly? So again, as you can see down here, one of the core components of the put broken wing butterfly is the short put spread. It's the same short put spread that we use in income strategy number 1 and number 2. Now, the difference is that this time we're going to use the short put spread to finance the second strategy that we're going to put on, and that is the long put spread, right? So we are going to use the credit which we receive from the short put spread. So let's say, for example, maybe we receive $1.50 for this. If we're going to receive $1.50 for this, we want to use a part of it to purchase this long put spread. So maybe we are going to use $1, right? So if, let's say, for example, we use $1, we're still going to get an overall profit of about 50 cents. So that means to say, if the market goes all the way up, we are still going to be in profit. Now, this long put spread down here, they are going to share the same short put strike as the short put spread above. So that's why you notice down here, there is 2 puts down here instead of 1. That is because right now, you are pretty much sharing the same put strike as the short put spread. So why do you want to use the put broken wing butterfly over the short put spread or maybe the jade iron condor? So here's the main difference between the 3 strategies. The put spread, the pure vanilla short put spread, is the most bullish of all 3 strategies. If you think the market is going to move up very quickly right after you put on the trade, then you want to put on the short put spread. Now, if you're not too sure whether it's really going to go up, you think it might probably go sideways, then you would want to put the jade iron condor. Now, what if at that point you are still not too sure, right? Maybe you are slightly more neutral to a little bit bearish, but you still hope that the market overall goes up, then this is where you put a put broken wing butterfly, because the put broken wing butterfly has the lowest break-even point of all the 3 strategies that I've shared. That means to say that the chances of you losing this trade is not as high as the other 2. In short, it has the highest win rate. Right, so it has the highest win rate. The other thing is also is that if the market goes up, then you're not going to make as much as the short put spread or the jade iron condor. The only time the put broken wing butterfly is going to really make a lot of money is if it comes down to this point down here, basically where your short put strike is. Where you want the market to be to make the most money is where your short put strike is. What about the DTE selection? So again, like I mentioned, the beauty of the strategies I've shared with you here is that they all share pretty much the same mechanics, right? So DTE selection, same thing. We go for above 45 DTE. As for underlying selection, same thing. We go for fundamentally good stocks, index ETFs, and this time with an added one, which is the cash settled index options, right? For example, XSP, SPX, so on and so forth. So for beginners, the safest is to go for the index ETFs and the cash settled index options because they do not really move that much. And also with the cash settled index options, you do not get early assignment, which means to say you can actually hold this trade to expiration. So how do you enter into a trade for the put broken wing butterfly? So as you can see down here, it's pretty much the same thing. So similar to the short put spread, we're going to use the stochastic oscillator or the RSI, and we're looking for the oversold reading, identify the support area, and then this time you want to construct your put broken wing butterfly below the support area. So remember, the put broken wing butterfly, similar to all the other strategies that we have shared so far, is that there is no risk to the upside. So same thing as this put broken butterfly. There is no risk to the upside. It's just that you do not make that much. So for this strategy, you actually do want the market to come down, and hopefully it stays there for as long as possible for your profit to slowly increase over time. Now, how do we exit the put broken wing butterfly? So for the put broken wing butterfly, it's going to be slight difference compared to the first 2 strategies that I shared with you. So the very first method, there's also the fixed take profit, but this time we want to have a much smaller take profit. And when I talk about the take profit, it's of the max profit. So when we were talking about the take profit for income strategy 1 and 2, we were actually talking about a percentage of the credit that we receive, right? But for this, we actually want to take the percentage based off the max profit, right? Because the credit that you receive is different from the max profit potential of this strategy. So what I'm going to do is that I'm going to very quickly just draw the P&L graph of how the put broken wing butterfly actually looks like, so you can have a visual representation of this. So basically this is the put broken wing butterfly, the P&L graph, how it looks like. This is the $0 line. Basically anything above this will be in a profit, below this is a loss, and below here is basically the price chart, right? The price. So that means to say if the market was to go up, it will be going to the right hand side. If the price of the market goes down, so in this case, if it goes down here, it will be on the left hand side, right? So as you can see down here, this is where the break even line is. And if the market actually goes up, all right, you can see down here, this is actually where it makes the least in terms of the max profit. So over here, this is actually the credit that you receive upfront. Right up front down here, this is the credit, but then your max profit is down here. So when I talk about the 15% to 25% of the max profit, I actually mean of this point down here. So this is where you need to go to your P&L graph to take a look at what is the max profit. Okay, so this is the very first method. Now, method number 2, same thing, is to exit at 21 DTE. Although if you exit at 21 DTE, your profit may not be that high. It's very hard for you to reach the maximum profit of the put broken wing butterfly, basically because it's a slow spread, which means it takes a long time for you to realize the max profit if the market actually comes down to where the tent of your put broken wing butterfly is. Now, method number 3 is a combo of method 1 and 2, like I mentioned, or method number 4 is to just hold it all the way to expiration, and you can only do this on cash settled index options. So this way, if you do it on a cash settled index options and you hold it to expiration, number 1, you're not going to have any early assignment. There's no assignment of shares as well. And there's also the potential profit of the max profit if it actually comes down to the 10. At the same time, your max loss has already been kept as well. So you do not have to worry about the max loss because you should already have the max risk of this trade as a small percentage of your overall account. Alright, so these are the 3 retirement income strategies. So let me know in the comments below which of these 3 you think is the most suitable for you. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.